Hey everyone, welcome back to Corporate Decoder, the place where we dive deep into the world of corporate filings. Today, we're cracking open the latest 10Ka from day One Biopharmaceuticals. This isn't just your average report, there were a few uh-oh moments, so we'll be sorting through those to see what they mean for the company and its investors. Think of it as corporate spring cleaning, but with million-dollar implications and paperwork. First, let's address why there's an amendment. The A in 10Ka turns out there was a little oopsie in their original filing that the company is fixing. It relates to a consent document from PricewaterhouseCoopers, their accounting firm. The consent mentioned the wrong date for one audit report and left out references to some registration statements, so it looks like a minor error that needed to be updated. Basically, the reports were not referencing the proper documents. Now let's move on to the meat of the report and take a look at the financial statements, which is our key focus today. So PricewaterhouseCoopers gave day one a clean bill of health, meaning they think the financials are presented fairly in all material respects, a crucial point to note. This includes an audit of not only the numbers, but also the company's internal controls over financial reporting. Digging a bit deeper, there's a critical audit matter worth mentioning, the accrued clinical trial expenses. This has to do with how day one estimates the costs of its clinical trials. Because these costs are based on estimates and judgments, auditors at PricewaterhouseCoopers took a closer look at how day one arrives at these numbers, making sure the process is sound and reliable. Alright, time to talk numbers. Total assets increased significantly from about $376 million in 2023 to over $582 million in 2024. This indicates growth, however this growth should be backed by earnings or other significant changes. Drilling down, we see a decrease in cash and short-term investments increased, meaning the company invested some money. As for liabilities, they nearly tripled. That's worth keeping an eye on to determine where that's coming from and whether it is sustainable. Now let's focus on the profit and loss. They had total revenues of about $131 million, which is great, because in 2023 there was exactly zero. However, operating expenses remain high at over $348 million. Fortunately, they had a big non-operating income because of a $108 million gain. At the end of the day, this meant, because they made more money from investments, they ended with a net loss of $95 million compared to a $188 million loss the previous year. Where is the company's money actually going? On the cash flow statement, we can see a net cash used in operating activities, meaning the day-to-day business is draining money. The company is actually running on investments. All this cash that is helping the company run comes primarily from stock and other investments, which they are using to stay alive. Okay, now let's step away from the raw financials and move on to other key parts of this amendment, the management side. Management says that their disclosure controls and procedures were effective as of the end of 2024. In simpler terms, they are confident that the information they are putting out there is accurate and reliable. Management also attested to the effectiveness of their internal control over financial reporting. This means management has confidence in their controls being effective. PricewaterhouseCoopers also audited the company and gave a similar assessment, providing assurance to investors that the company's financial reporting is reliable. During the most recent quarter, there were no changes that would have materially affected internal control over financial reporting, which is good. Alright, let's scroll down to the exhibits section. It contains the list of contracts and legal fillings. While most exhibits are standard, it's here that we find some key agreements of the company. You can find the details on everything from their charter to agreements with key players like MabCare and Ipsen Pharma. It is worth it to check these for significant and large risks. And finally, the signatures. CEO Jeremy Bender and CFO Charles York are signing off on this report, putting their reputations on the line. Now for my overall take on day one, the company has some major strengths. OJEMDA's early success and the Ipsen partnership are major wins, pointing towards a smart strategy and good market traction. However, that jump in liabilities and continued losses raise some eyebrows. The company is burning cash fast and relying on investments to keep the lights on, which isn't sustainable long-term. So the biggest risks are the need for cash, competition, and development risk. The company appears to be depending on success in Firefly 1 and Firefly 2 to secure success. I would not bet on the company until the results of the trials are done. Thanks for watching Corporate Decoder. If you found this breakdown helpful, hit that like button, drop a comment, and subscribe for more insightful dives into the world of corporate finance.